Stock markets ended the week reaching new highs for 2 straight days. The Dow, Nasdaq, and the S&P 500 all clocking records on Thursday and Friday. Part of that rally has to do with President Trump finally getting what he wanted from the Federal Reserve after months of pressure, an interest rate cut. But Fed Chief Jerome Powell has signaled that he's putting the economy first, not politics, and is trying to keep inflation tightly reined while shoring up cracks in the job market. Betsey Stevenson joins us now live. She's an economist at the University of Michigan. She was on the Council of Economic Advisors under President Obama. Betsey, thanks so much for sharing your Saturday with us. What grade would you give the American economy right now?
I think I would give it a B minus. So it's not terrible, but it's not performing to its best potential. That's sort of the problem.
So there is a slowing job market. Inflation is still not at that 2% mark where the Fed wants it. And yet the stock market is doing great. Why is that?
Yeah. Okay, so let's think about what the stock market's all about. It's trying to tell us what the future stream of profits is worth today. Why are so many investors betting that the future stream of profits is worth more today than they even thought it was 2 or 3 weeks ago? I think most of that optimism is coming from AI. So what are profits coming from? Profits are, how much money can we make sort of minus our costs? And AI promises enormous productivity gains that could mean a surge in profitability. And I think, there's a survey out of the Business Roundtable, I think, puts a really fine point on this, which is if you ask companies what they're planning to do in the next year, you have nearly 90% of them say that they're going to make investments in capital, but less than 40% say they're going to be investing in workers. So what we're seeing is a lot of companies are shifting towards trying to get those productivity gains from AI at the same time that the economy is slowing down. And right here and right now, their costs are up because of tariffs. And so those two forces are playing out and leading us to record high stock market prices, while at the same time, it's a really tough time to find a job right now if you don't have one. Most people still have a job and we still have pretty low unemployment, but it's a bad time to lose your job because we're seeing a slowdown in overall hiring, and there's more unemployed people than there are job openings. And whenever that happens, right, that's sort of a bad situation. It's like a game of musical chairs when there's fewer chairs than there are people trying to find a seat.
Yeah, that's a really good way to put it. I wonder what you make of the Fed's interest rate cut of a quarter point. There was one exception. Steve Mirren, the new pick that Trump Trump nominated for the Reserve Board of Governors, he voted for a 0.5% cut. I wonder what you make of the Fed's timing here and their forecast for more cuts coming for the rest of the year.
So the Fed is in a really tough place right now because the Fed has a dual mandate, which is keep prices nice and stable, and want to keep inflation low at 2% a year, and you want to keep employment at full employment. And we don't have either one of those, but they're tools. If they cut rates, they push prices up. And if they raise rates, they push employment down. So the question is, what should they be doing right now? I think most economists agree that they need to be thinking about bringing rates down. I personally am somebody who worries much more about unemployment even than inflation. So I would be leaning on the cut. The 25 basis point cut was the right thing. The thing is, you don't want to go too quickly, though, because it does hurt people when there's inflation. And we know the inflationary pressure is there. And the way the rate cut works is to try to stimulate demand so that people and companies will try to buy more things. The problem is that the reason prices are going up is because there are shortages and real cost increases that have come because of the tariffs. So having more people chasing those things with rising prices is just going to lead the prices to go up. And so it's really tricky business. I think the Fed did the right thing with almost everyone voting for that quarter point increase, which the market was expecting. They had fully priced it in. I think the most really scary thing about Steve Mirren's dissent is that he had just been put on the board. And it would be traditional for him to say, let me get up to speed before I dissent with all of you people who've been looking at all the numbers and thinking hard about this for a long time. Instead, he walked in and said, the president wants me to do something and I'm going to do his bidding. And that is a real threat to Fed independence. I hope that he gets his sea legs soon and starts to vote based on what he thinks and his interpretation of the data, rather than taking the White House into the FOMC meeting.
Yeah, that'll be one aspect of the Fed's next meeting that we'll all be watching very closely. On the housing market, do you think that a quarter percentage point cut would be enough to get potential buyers off the sidelines?
I think the thing that really holds people back is when they're looking at what are my wages going to be and am I going to be able to pay this mortgage? I don't think a quarter point is going to do that much to get people out there. I think what we really need to do is get people convinced that the labor market's going to be strong and that there's going to be a lot of opportunities out there. And I think that's probably more important. And honestly, the other thing we should do for housing is just make sure that it's a robust market with a lot of supply and a lot of movement and a lot of dynamism. That's how when the housing market starts to solidify and people don't want to sell and they don't want to buy, it